Welcome to The Explainer. Today we are digging into a real head-scratcher. Salesforce just posted what looked like fantastic earnings, so why on earth did its stock take a nosedive? Let's figure it out.
So, on the surface, the news from their latest report was all good. I mean, by almost every metric you could look at, it was a home run, a really strong quarter.
For starters, they pulled in a record-breaking $10.2 billion in revenue. That's a huge number.
And that's not just a big number in a vacuum, right? That's a solid 10% increase from the same time last year, and it actually beat what analysts were expecting.
And then there's this, a super strong non-GAAP operating margin of 34.3%. Now, all that really means is they're getting more and more profitable, and this was actually their 10th quarter in a row of margin expansion.
So you look at these numbers and you think, okay, Wall Street's got to love this. But they didn't. Nope. In fact, they did the exact opposite.
The day after these results came out, Salesforce stock dropped a whopping 7%. So what gives? What happened?
Okay, let's put on our detective hats and dive into this thing. To solve this mystery, we've got to look past the headlines. You have to remember, the market is always looking forward, and it found a clue that pointed to a bit of a cloudy future.
And that first clue isn't really in what Salesforce did report, it's in what they're projecting for the future. And it all comes down to one kind of clunky but absolutely critical acronym, CRPO.
Yeah, this is the metric that totally spooked investors, CRPO. It stands for Current Remaining Performance Obligation, which is a mouthful, I know. But here's the simple way to think about it. It's basically a snapshot of all the money Salesforce knows it's going to make over the next year from deals it's already signed. It's like a crystal ball for their near-term sales pipeline.
And this is where that first red flag popped up. The total KRPO number was huge, $29.4 billion, which looks good. But the key is the growth rate. It's slowing down. It dropped from 11% last quarter to 10% this quarter. Now that might seem like a tiny change, but for a market that is obsessed with growth, any slowdown is a big deal.
And the real concern wasn't just about this one quarter. It was about the trend. The company's own guidance, what they're telling investors to expect next quarter, predicts that slowdown is going to continue. They're guiding for CRPO growth to drop even further, to slightly above 9%. That downward trend is exactly what grabbed Wall Street's attention and made them nervous.
Now let's jump over to the earnings call, because this is where things really started to click. The numbers told part of the story, sure, but the way management talked, well, that provided the real aha moment for everyone listening.
And here it is. This is the quote from CFO Amy Weaver that gave investors all the context they needed. She's directly confirming that a sales slowdown that actually started 2 years ago is still causing problems. So this isn't some new, surprising issue. It's a lingering effect that's just now really showing up in their forward-looking numbers.
And it wasn't just the CRPO warning. The CFO also pointed to some specific weak spots, like their marketing and commerce clouds. And get this. Even though they raised their revenue forecast for the whole year, it was a very cautious move. They only lifted the bottom end of the range. So all these little signals, they started to add up, painting a much more careful picture than those big headline numbers suggested. So what you've got here is this really fascinating conflict, right? On one side, you have these cautious, maybe even slightly worrying short-term numbers. But on the other side, you've got CEO Marc Benioff painting this incredibly optimistic, almost revolutionary picture of the future. It's really a tale of two different outlooks. The reality, the numbers, they're showing slowing growth and some headwinds coming up. But then you have the vision, the story that Benioff is telling. He's talking about the Agentic Enterprise, a future where smart AI agents just do complex stuff for businesses automatically. He's calling it the most transformative time in the industry's history, and to be fair, he's pointing to the insane 120% growth in their data cloud and AI business as proof. So the market is left trying to weigh this cautious present against a spectacular, but maybe not quite here yet, future.
So what's the big takeaway from all this? Let's put these puzzle pieces together and finally solve this paradox once and for all.
You know, it's a classic case of the market caring way more about where a company's going than where it's been. Those fantastic Q2 results, that was like looking in the rearview mirror. The slowing CRPO growth and all that cautious language from management, that was a look at the road ahead. And investors, well, they saw a few potential speed bumps.
And that leaves us with the big multi-billion-dollar question. Can Salesforce's massive bet on AI, on this Agentic Enterprise actually reverse the trend? Can this powerful new vision overcome the current slowdown and get that growth engine firing on all cylinders again? That is the story to watch in the coming quarters.